right? These two ratios are only for CBSE students. One is fixed assets turnover ratio. So it is the ratio of RFO to fixed assets. This ratio reflects how well a business uses its fixed assets and its usage convert their usage into sales, that is turnover or RFO. So fixed assets turnover ratio is RFO, that is total sales or total revenue from operations upon fixed assets. Right, guys? And the last ratio that we have is net assets turnover ratio. So it is the ratio of RFO to net assets and reflects how well a business uses its net assets. So net assets turnover ratio is total RFO of a business divided by its net assets. And net assets are total assets excluding non-trade investments minus all external liabilities. Have you got this, guys? Mishika, Avi, and others?
Yes, sir.
So, guys, note down these ratios. For ISC students, there are total four ratios till working capital turnover ratio. For CBSE students, there are total six turnover or activity or asset management ratios. Right? What is common among all the turnover ratios is that more the ratio, better it is for the business. So every business should try to keep their turnover ratio as high as possible. So all the turnover ratios should be as high as possible and obviously should be more than one. They all show how the how well a business uses its assets. Note down this much, guys. Done, guys, all noted down this.
Yes, sir.
So now, guys, we are left with the last type of ratios, that is profitability ratios. So these ratios are about profitability of a business, that is performance of a business in terms of its profits and management of its expenses. These are gross profit ratio. So here the first one is gross profit ratio. It is percentage of gross profit. Now, guys, till activity ratios, all the ratios are calculated in times. Now, here, all the profitability ratios are calculated in percentage. So, gross profit ratio, guys, it is percentage of gross profit on net RFO of the concerned business. So, gross profit ratio is gross profit upon net RFO, means net sales, into 100. Right, guys? Now, how to calculate gross profit is net RFO, means net sales minus cost of RFO, that is cost of goods sold. And how do we calculate cost of goods sold? That I have already explained you under inventory turnover ratio. Do not forget this, guys. Otherwise, also this chapter is very important because it is one of the easiest chapter. Here you do not need to make any statements, any account, any balance sheet. Here you just have to do the calculations, and for that you should have good understanding of financials or accounting items of a business. Yeah, you should also be good in basic mathematics. Have you understood, guys, or not?
Yes.
Yes. This is the formula of cost of RFO or cost of goods sold. If you guys and if you see this carefully, you will find that this is nothing but it is presentation of trading account of a business in form of equation, right? Here we have minus sign and here also we have minus sign. So after opening the bracket, closing stock would be in plus. So what exactly would be net RFO plus closing stock, which is credit side of trading account minus debit side of trading account where we have these three items, that is opening stock, net purchase and direct expenses. When we say net RFO, it means sales minus sales returns. When we say net purchase, means purchase minus purchase returns. Hope you have got this, guys. The second one, guys, is net profit ratio. So it is also like the one that we saw here about gross profit. So it is percentage of net profit on net RFO of the concerned business. So net profit ratio is net profit upon net RFO into 100. And guys, what does this gross profit ratio reflect? It reflects how much profit a business earns out of each 100 rupees of its sales. So if gross profit ratio of a business is 16%, yes, it would be in percentage that I have already explained you. It means out of every 100 rupee of sales, the business earns gross profit of rupees 16. Have you got me, guys, or not? I hope you all are listening, guys. Right, Avi? You are
Ye-
there in the class.
Yes, sir.
Avi, are you there in the class? Can't you speak, Avi? Are you sitting in a movie theater?
No, sir.
No, sir. Okay. I hope, guys, you all have understood this. Now, what is the use of this? I tell you, guys. You all understand gross profit. But for a trader, usually the one who deals in general items, right? Whenever salesman of a new company comes to the trader and requests him to start keeping his goods also in his business, in his shop, the very first question the trader asks is what is the margin? Why should I sell your product? What margin your company is giving me? And that margin is nothing but it is gross profit ratio or gross profit margin. The salesman says that it is 22%. It means if the selling price of the good, MRP of the good is rupees 100, then 22 rupees will be earned by the trader. It means the cost of that good for the trader that he has to pay to the company is only 78 rupees. And with that gross profit margin, the trader decides whether he should really sell that product or not, apart from some other criteria. I hope you're understanding what I'm trying to tell you guys. Yes or no?
Yes, sir.
Yes.
Good. If the margin is less, trader usually would not like to keep that product and sell that product from his business. Right? The same way, when you are going to start a business, right, and you decided to start a business of a particular product, the very first thing that you will keep in your mind is gross profit margin. If the margin is less, you will not start business of that product. If margin is more, then only you will start business of that product. Usually, gross profit margin or gross profit ratio of most of the products that we see around us is more than 20, guys. And out of that 20% margin only, 20 or more, from that only every businessman or trader takes care of his indirect expenses. And after taking care of indirect expenses, the net profit that is left in his pocket is 5 to 12, 13, 14%. Means against every 100 rupee sale, what is left in his pocket after meeting all the expenses, whether direct or indirect, is rupees 12, 13, 14, like that. I hope you all are understanding this, guys. And you are done with this also. Should I go ahead in case you are done with this?
Yes.
Next, guys, is operating profit ratio. Between gross profit and net profit, there is one more profit about which you have already learned in class 11, guys, and that is in final accounts chapter, and that is operating profit. So, what is the ratio of operating profit to net RFO to net sales is operating profit ratio. So, have you all noted down this, guys?
Yes, sir.
Everyone, guys, all? I'm asking.
Yes, sir.
So guys, how to calculate operating profit, that I will tell you tomorrow in our next class. Right? I'm sorry I cannot extend this class. We'll see it tomorrow. Thank you guys.